So with the whole Iran war and all of that stuff, now that there's like this agreement, this maybe agreement, what has changed? What's going on? How is that affecting oil prices? Like what's
Yeah.
going on there?
Well, clearly there's been a significant drop in the price of oil just because of that agreement, in spite of the fact that you haven't had a significant change in the flow of oil through the Strait of Hormuz yet. But you've seen oil drop, from 90 down to 70 in the last month. That's nearly where it was before the war began. So prices have come back down dramatically as a result of just the expectation of the flow of oil picking up. That's clearly been good for the markets. The other impact that it's had is it's also helped the market's perspective on inflation because oil is so critical to a lot of what we do, especially not only what consumers spend and put in their gas tank, but transportation costs and all the input costs for oil itself. Now you're seeing some of the inflation expectations coming down, and you're seeing that in the 10-year Treasury yield dropping as well. So you've seen the 10-year Treasury come down from about 4.5% down to into the 4.3 range. That has all been very, very helpful, and that's supportive of stock market expectations as well. The hope is that with this memorandum of understanding, if you get oil prices down back to where they were before the conflict began, and potentially even lower, there's a lot of people who believe that really since 1979, when the Iranians deposed the Shah, and you had this theocratic government come in. That there's been a premium on oil prices globally since 1979. And the estimate is somewhere between $5 to $15 a barrel is how much they think oil prices have been higher than they should be normally. And if you actually get a permanent solution to the Middle East and you take away this threat of the Strait of Hormuz ever being
Mhm.
closed again, like it's been during this conflict, that you could see oil prices drop by another $5 to $15 a barrel below where they were prior to the conflict itself. That would put oil prices into the 40s, mid 40s to $50 range. That would be really beneficial for the global economy, clearly beneficial for markets, and also beneficial for helping reduce some of the inflationary pressures that we've been seeing.
Yeah, I guess that would really help like gas prices and stuff like that. Like that could
Absolutely.
you could see
And if
huge
you think
drops.
about it, higher gas prices really are a tax on the consumer. Every
Mhm.
time somebody has to put another dollar in their gas tank because of higher gas prices, and people feel it and see it there immediately, that's less money that they have to spend elsewhere in the economy. So at the end of the day, it really impacts consumers, and consumers are 70% of the U.S. economy. So anything that adversely impacts the consumer has the potential to impact the economy. And when you start thinking about the impact that that's had on inflation, and it's not only current inflation, but it's inflation expectations. And I think that's really been the primary benefit of seeing even this temporary memorandum of understanding, which I would just call it, this temporary agreement, which is a step towards a permanent agreement. But just seeing oil prices moderate as much as they have, I think that that's really beneficial for those inflation expectations to start moderating and coming down. And clearly that's going to have an impact on the Fed, potentially give them some room to not have to hike rates. Because I would suggest that if we stay in the current environment that we're in, you're likely going to see the Fed having to hike interest rates. That's what the last Fed meeting indicated, was the expectation of potentially two rate hikes yet this year.
Mhm.
But that was also under the expectation that this conflict, may continue longer. If we can truly get a resolution, I think you end up seeing prices moderate, and maybe the Fed goes from having to hike rates to actually being able to cut rates.
Okay. So with cutting rates, how would cutting rates or hiking rates affect things like housing, just anything in the economy, even groceries or anything? Like, how would that affect that?
Right, right. Um, well, one thing that I've always talked about is how important interest rates are to the economy in general. If you think about it, interest rates set the price of everything. It sets the price of, what you should pay for a stock, because how you decide what you pay for a stock is basically discounting future earnings to a present value. higher interest rates make future earnings worth less in today's dollars. So you'd pay less for a stock if you assume higher rates of interest. If you assume lower rates of interest, that allows you to pay higher multiples, and it makes those future earnings worth more in present dollars. So interest rates affect stock prices. Interest rates clearly affect consumers because higher borrowing costs means you're spending more money on interest. You've got less money to spend somewhere else. So lower interest rates help consumers not spend as much on interest, therefore have more money to spend in other places. And then if you think about housing, which is really one of the major components of our economy, interest rates and mortgage rates are, the 10-year treasury and mortgage rates are very linked. And because we've seen interest rates push higher because inflation expectations have been pushing higher, that puts more pressure on housing as well. So
Mhm.
lower interest rates are just generally better. It's why you see the president advocating for lower interest rates. And I would suggest that every president has wanted lower rates. But that's why we're supposed to have an independent Fed so that they are clearly looking at the economic data and not being subject to political pressures, because every president would like to see rates lower, a better economy. And clearly, this president is no different from any others in that respect. But when you think about, an independent Fed, and now we have a new Fed governor in Chairman Warsh, um, although with the old chairman still sitting on the board, kind of an awkward position for him to
Mhm.
be in. It's kind of like a president, leaving office and uh, not, the former president staying in the cabinet, right? That's that's not necessarily the way this is supposed to work, but that's the situation that we have presently. But you have a new chairman of the Fed who's trying to, I think, uh, establish his own credibility, and markets tend to test a new Fed chairman relatively early, and this one is coming in the middle of a conflict, one where inflation has spiked, and one where you've got a president who's clearly uses the bully pulpit of social media,
Mhm.
and in a way that probably no prior president has ever done. And obviously, we're in a new era of communication,
Yes.
but when you have a president who's so vocally advocating for lower rates, yet a new Fed chairman who's trying to establish credibility.
Mhm.
And if you think about it, they want to establish credibility in the sense of that they're going to be tough on inflation. They're going to be hawkish. This Fed is probably going to talk very hawkish, but my belief is they're going to act somewhat dovish, meaning they're going to
Mm.
threaten to raise rates, hope that the threat of jawboning the markets into believing that they're going to be serious about um, getting inflation back towards their target of 2%, but recognizing that they really don't want to have to hike rates, especially in light of the pressure that's probably would be brought by the White House on them if they were to hike rates. But from a global perspective, they really need to establish credibility on their willingness to fight inflation. And I would
Mhm.
suggest, if you look back over the last 3, 4 Fed chairman since, I mean, Volcker back in the 70s and early 80s. You had, Paul Volcker, who was the chairman who came in and finally broke the back of inflation in the late 70s, early 80s. He came in the early 80s when we had a double dip recession, and you had inflation running at 13%, and he raised rates, to such high levels, just really crushed inflation. But I would suggest that, after him, when Alan Greenspan came in,
Mhm.
recently passed away at age 100, Greenspan kind of followed in that same mold of, trying to be hawkish. And then you had Ben Bernanke, and then Janet Yellen, and then Chairman Powell that just recently
Mhm.
stepped down, and now Kevin Warsh. So all of them really tend to get tested by markets, and establishing credibility on inflation is really, really important. So to me, the Fed is more likely to talk tough, and I think they've
Mhm.
started out with that with this first meeting. But I really believe that they would like and hope that this resolution in this conflict and oil prices moderating does some of the heavy lifting for them and takes some of these inflationary pressures out of the economy, takes it out of the market, and does it without them actually having to hike rates because higher rates, the market is really not priced for higher rates right now. When you're trading at the valuations that we are, I think that lower interest rates are what the market really needs to sustain these levels of multiples for the market.
Okay. Um, so there has been you mentioned just a little bit ago, like some of the older Fed chairs, um, and how they kind of had effects on the market with all of that stuff. In 2000, there was a bubble, and some people say that right now there is a bubble. What is the similarities and differences of what's going on between the two time periods?
Yeah. One of the benefits of having gray hair is the fact that I was managing money during that period. So it's one thing when I think about younger financial advisors
Mhm.
who haven't lived through a period like that, what a disadvantage they have in maybe not necessarily recognizing some of the similarities, because I don't think that you really get the same impact by reading about things in a book versus having lived through them,
Yeah.
right? But for someone who actually managed money for retirees and investors in general during that period, um, there's a lot of similarities. And I would say if you think about it, a lot of this is psychological and human beings, even though we know a lot more today than we've had before. I mean, we walk around with all the information in the world at our fingertips in our pockets
Mhm.
nowadays. So I'd say, we have the benefit of access to information now that we beyond anything we've ever had previously. But when you think about how we are wired as human beings, the two strongest emotions when it comes to investing are greed and fear. And when you think about the period that we are in now, I would suggest we are in the greed phase. We are in the
Mhm.
phase where, if you think about most investors since the lows in 2009 after the Great Recession, March of 2009, the market hit the low of 666, the devil's low,
Mhm.
and since then you basically had a period where the the Fed was able to keep interest rates close to zero during most of
Mhm.
that period since. They printed a ton of money. The government borrowed a ton of money. And the benefit of all of that on the economy has created this environment for investors where the only world that they remember, I mean, think about this, March of 2009, over 17 years ago, you're talking about an entire generation of investors who've really never invested in a period of higher inflation,
Mm.
higher interest rates, and if you think about the tools that the Federal Reserve and the U.S. government have had at their disposal to navigate through these tougher periods, what I would say is emotionally, this is very similar to the euphoria of a disruptive technology, just like when the internet and cell phones and smartphones and all that really changed the world. And I would say leading into that, what we now know and call the dot-com bubble back in 2000, that what we have is it's normal for people to get excited about these things.
Mhm.
And it's normal for people to have that fear of missing out, that FOMO, right? And when they see things only trending in one direction, it gets easy for investors to start to believe that the market only goes one way. And I would
Mhm.
suggest that in the 1990s, if you look back at what led up to that period in 2000, you basically had a decade where you had low inflation, low energy prices. I would also suggest you had really favorable demographics. I mean, the baby boomers in 2000 were 30, the oldest baby boomer was 54, the youngest baby boomer was 36. So you had the biggest cohort in this country in their peak earning years. The country, you had all of the benefits of computers and the advancements in productivity that happened in the 1980s and 90s, as technology began to advance fairly rapidly, the benefit of that and more productivity brings inflation costs down. It's one of the elixirs or secret sauces of that we're hoping will be realized from this AI advancement
Mhm.
is this, hopefully we get this rapid boost and jump in productivity, which would also help quell inflationary pressures.
Mhm.
But if you go back to the 1990s, you had a decade where you had markets averaged 19% a year for the entire decade of the 1990s. In the last 5 years of the 1990s, from 95 through 99, the S&P averaged over 25% a year during that period,
Mhm.
which led to a bubble. And when you have investors who continually are conditioned to buy every dip, and they're rewarded for doing so, it gets really easy for them to continue that behavior. And every time the market goes down, they just step in and buy. And when the market benefits and rises as a result of that, you get conditioned to do that every time. Well, that works until it doesn't, right? And what happened in going into the late 90s, early 2000s was you had this period of euphoria. You had this period of investors who had been conditioned to buy every dip. The What tends to happen in these when you have these technological disruptive advancements that happen, there's this psychology of the old rules don't apply. We're in a new
Mhm.
era because we're into, this disruptive technology is going to affect the economy in a really positive way. And
Mhm.
that's the hope and expectation. So a lot of times what people start to forget about is valuations
Mhm.
and what should you pay for a stock. And ultimately that's what happened in that period was people just lost sight of what is a reasonable valuation. And,
Mhm.
and I'll never forget uh, the uh, the mindset in that period was, well, this time it's different, right?
Mhm.
And what I would tend to say is over time, it never is different, right? It's always the same stuff, and we tend to go through these emotional cycles. It's why economies have, the economy itself has a cycle.
Mhm.
There's a cycle when it comes to investing, and it's natural when you have these robust periods of outsized returns, and they just continue for what appears to be an extended period of time.
Mhm.
Well, think about it, and this is one of the things that when I say this period reminds me a lot of that period in the late 90s going into early 2000 is we've had the same things happen this time. We've had the benefit of this disruptive technology, whether it's AI, quantum computing, uh, 3D printing, all of these things that really are changing the world and are very, very exciting, and that excitement is justified. The question is what is the valuation that you apply to a stock that's in that space? And if we go back and look at the lessons learned from 2000, it's really easy to see that valuations did still matter.
Mhm.
It wasn't different that time. It just took a while for those old metrics to actually have an impact on the market itself.
Mhm.
And what gives me even more caution at the moment is when I think about you know the similarities of that period, the incestuous relationship of vendor financing, where
Mhm.
companies are basically, GE back in that
Mhm.
period did a lot of that, where they wanted to sell more, of what they were producing, so they would ultimately provide the financing to their customers. The
Mhm.
question is if the customers couldn't get that financing any other way and get a return on that purchase in any other way, without that financing, could they really continue that rate of acquisition or that rate of buying what was being produced? The same thing applies right now. I think whether it's Nvidia or any of these companies, a lot of them are doing a lot of the same type of vendor financing. That
Mhm.
has always been a precursor to a bubble-like period in valuations. So when I think about the similarities, I would say psychologically, very similar. Outsized returns, very similar. What I would suggest is this time, the concern that I have is the setup from a macro perspective is very different. In 2000, we were running a budget surplus.
Mhm.
Now we're running a $1.6 trillion a year budget deficit.
Mhm.
Back then we had a 60% debt to GDP ratio. Now we have 120+% debt to GDP. The baby boomers are no longer um, uh, 36 to 36 to 54. 26 years later, they're now 60, what, 62 to 80,
Mhm.
right? So when you think about how that impacts Social Security, Medicare, all of these, areas where government expenditures have just gone up exponentially, we're in a much more difficult environment for the two main entities that tend to help fight this,
Mhm.
i.e. the Fed, in lowering rates. Back in, coming into the dot-com bubble in 2000, the Fed was at, I want to say 5.25 on Fed funds rate, and the 10-year Treasury was about 6%. So you had room for the Fed to cut rates, and they did. As a matter of fact, they started cutting rates in late 2000. Actually, first week in 2001 was when the first rate cut happened. Then September 11th came, the
Mhm.
Fed cut rates all the way to 1%. So the Fed cut from over 5 down to 1. The 10-year Treasury was at 6. It came all the way down to in the 3 to 3.5, 4% range. So interest rates could come down. You still ended up with a 78% decline in the NASDAQ, which is where
Mhm.
most people were invested because that's where all the excitement was in the
Mhm.
dot-com era. The S&P dropped 49% during that period from March of 2000 to October of 2002. And you ultimately have this, you had the Fed that had plenty of room to maneuver because inflation was not a problem,
Mhm.
right? And the government had very low debt to GDP. We were running a budget surplus. The government could spend a lot of money and add to their, borrow money, add to the national debt, which they did. The Fed could cut interest rates. They could expand their balance sheet, print money, which they did. It didn't stop a 2.5 year bear market, which was the first market where where you had 3 consecutive years where the market was negative. That was the first time in history that had ever happened, and it still happened in spite of all of the latitude that the Fed had and the
Mhm.
federal government had. Fast forward to today, you've got all these pressures on Social Security and Medicare, which are
Mhm.
projected to run out of money over the next decade,
I
both of
think
them.
31.
Yep, yep. Both of them are projected to, fall short on funding. You're borrowing 130 to 140 billion dollars a month on average right now. You've got a national debt that's, pushing, 40 trillion. I think we're at 39.3 or something like that right now. So we've got this enormous national debt. You put most of that debt on the balance sheet
Mhm.
when interest rates over the last 20 years were close to zero. So you basically had super low interest rates, which made us not really feel the impact of all of that debt. Um, because rates were so low.
Mhm.
Now that rates are higher, and it's why it's imperative that you get inflation down and you get
Mhm.
interest rates down because the cost of servicing that debt is so important and impactful. So this time you've got the federal government that really has borrowed probably more than they should have and would
Mhm.
like to get that rate down dramatically. And then you have the Federal Reserve that would liked to be able to cut rates, but probably can't because you got inflation running too hot. So the tools that the government used to get out of the crisis in 2000 to 2002, I would suggest they use those same tools again during the Great Recession in '07 to '09, which
Mhm.
was the worst recession since the Great Depression.
Mhm.
And when you think about then when you had the pandemic in 2020, they used all those tools that they had used successfully to get through those difficult
Mhm.
periods, and they used them on steroids this time, printed
Mhm.
$4.5 trillion in about 2 years out of thin air, increased the money supply by 42%. When that all happened, that's what led to that initial surge of inflation that we had in
Mhm.
21 and 22. And then obviously we got inflation, a little more moderated over the last year or two, only to again spike more recently as we've had this conflict, which caused oil prices to spike. The hope is we can get that, to come back down more naturally without having to go through what Volcker did in the early 80s, which was basically raise rates so high that you basically crash the economy to get inflation finally in check.
Yeah. And you've been mentioning like a lot of these like valuations. You were like paying too much for something. SpaceX, you have made the case that it was a little too high. Its revenue, it's making, or no, it's valued at over 100 times revenue. So, and I know that like some of these coming companies like OpenAI and Anthropic, they're also planning on uh, IPOing, and I know that they're also supposed to have pretty high valuations.
Yeah.
Um, that plays into this.
Yeah. Well, let's start off by saying number one, we're not making any recommendations when we're talking about
Yes.
individual stocks, and we're just talking about these things for educational purposes. But I do think that what transpired with recently with SpaceX, and clearly we're in the early stages because the IPO only happened a few weeks ago,
Mhm.
and uh, but if you think about these companies coming public at this size and at these valuations, I think couldn't happen unless you had that excitement and euphoria that has been prevalent in the market as of late. So I think the environment that has allowed a stock like SpaceX to come public at that kind of a valuation, and to put it in context, when Apple came public, it came public at 10 times revenue.
Mhm.
SpaceX came public at over 120 times revenue. And I want to say after the stock ran up initially, it was trading at, nearly 200 times revenue. Obviously that stock, price has moderated more recently after that initial, fervor. And one reason why I would say valuations are things that people need to again pay attention to, but it's easy when you're in this environment to ignore that because the excitement about these things, and you just don't know, is this going to create a surge of productivity that ultimately creates an environment where valuations really can be higher and sustainably higher, and where that will in fact help bring inflation down and interest rates down and all these other metrics that would help justify and support those price levels. So to me, when I think about what SpaceX itself represents to investors is that excitement of
Mhm.
the future. This and let's face it, here we are, getting ready to celebrate the 250-year anniversary
Mhm.
of the greatest country that's ever been, on the planet. And God has truly blessed our country tremendously, and that freedom and that entrepreneurialism and that capitalism, which I would suggest we are re-embracing.
Mhm.
There's still, parts of our society that doesn't embrace that mindset,
Mhm.
but I think that you've kind of seen this recognition that kind of what makes us special. And it's one of the things, when you think about immigrants, Elon Musk is an immigrant,
Yes.
right? And he came in, and like many immigrants have done, came here, and took advantage of the opportunity that our country presented, and has done things that is, clearly changing the world. And all of that is exciting. But I don't think that it means that you can just ignore valuations,
Mhm.
because when I hear this time it's different, or those things don't matter anymore, I think over time you end up coming back to a point where you realize that they do. It's just that we chose to ignore them for a while because the pricing and the price performance allowed you to do that. I just believe that, when you see uh, a stock that's raising as much capital as SpaceX did,
Mhm.
and now you see other very large companies. Now, I also have been hearing that some of those other companies that were expected to come public relatively soon have potentially decided to delay that into next year, because I would believe, of the volatility that you've already seen in
Mhm.
SpaceX pricing just in the last couple of weeks. And I think that that may cause a little more caution from those companies, whether they want to go public in this environment yet. And I think that if you, unless you see a really successful follow-on price improvement by all these investors that have jumped in and bought SpaceX so far, you may not see as much excitement for some of those other big
Hmm.
companies coming public if SpaceX doesn't have the results that people are hoping or expecting.
Hmm. Um, yeah, on top of the SpaceX thing, I saw that they had acquired a company called Cursor. Do you
Mhm.
know anything about the whole Cursor acquisition or anything like that?
One of the things that I do know is that these companies are, when they become that scale, one of the advantages that they have is that they can start buying the technology and the innovation that from these companies that, in essence, rather than allowing those companies to go out and compete with them, they're so large and their currency being their stock price is
Mhm,
so strong that they can literally go out and simply merge those companies into
mhm,
their entity. So I think it's the benefit that all of these enormous companies have
mhm,
is that they obviously have their own development and research and development arms within their own organizations, but they also have the resources to go out
mhm,
and acquire the companies that are doing innovative and exciting things and just help them become even more scalable. And I think that this is one of the things that the country has to kind of deal with. If you think about it, we're in a global environment, and having the best technology and and the most advanced and innovative companies in the world, domiciled here in the US is really critical. On the flip side, how big is too big, and does that really allow for competition to come into the marketplace if you have these big companies that just start gobbling up these
mhm.
innovators and helping them get to an even more robust size.
And you mentioned this. You mentioned the um, how SpaceX has basically affected the AI market and how it's pushed back IPOs. But how has the SpaceX IPO affected like the communications industry or the space industry?
Well, one thing that I would say is that one of the biggest questions that I think people need to ask themselves is when you think about how the market has rewarded the companies that have invested in, these hyperscalers that have invested in these data centers.
Mhm,
And now you have a company that everybody's so excited about, and it is truly changing how we think about space and
mhm,
how we think about satellite capabilities, and how rapidly we may be able to ramp all of that up, and how
mhm,
cost effectively or more efficiently we may be able to do that than we've ever been able to do in the past. Um, what does it mean to these companies that are spending all of this money building data centers here on Earth, where
mhm,
you have power constraint issues, where you have cooling issues, where you have environmental issues,
mhm,
um, country. I mean, I would say these data centers are almost like prisons. It's like we know we need them, we just don't want them in our neighborhoods,
mhm,
right? And so I think that you're seeing some of the limiting factors of building these enormous data centers
mhm,
here on Earth. And now you have a company that is saying, hey, we think we're going to have, if we can continue to bring launch costs down as
mhm,
dramatically as we're projecting being able to do, um, and can we build these in space
mhm,
where cooling is no longer an issue, where you have literally an unlimited supply of power, solar,
mhm,
right? And two of the main constraining factors on the data centers
mhm,
themselves, and somebody who's saying, hey, they believe in 2 to 3 years we're going to be able to do this at scale in space. What does it do to the valuation or what it's worth for these all this money
mhm,
that has been spent on the data centers here, you know, around the world, mostly in the US, but all around the world? And how economically viable are they? And I think it really brings what Michael Burry has talked about into focus, where he's saying, are we accounting for the expense of these and how quickly they are likely to become obsolete, and how much and how short the life cycle may be on them, the effective life cycle, when you see how fast things are changing. And I think SpaceX is really one of the reasons why people were so excited about SpaceX is the total addressable market of
Mm.
AI, which I think is currently 29 trillion is the
Mhm.
current projection. But you think about all the companies that have been rewarded for all of the money, the hundreds of billions of dollars that they've already spent on this stuff. I would suggest virtually none of them actually making any money on AI.
Mhm.
And I would suggest that thus far, hard to quantify the actual improvements in productivity and cost savings from AI. I know there's a lot of hope that that's going to be realized, but I don't think that you've actually seen any evidence of that. As a matter of fact, the people that I've talked to that work in that space say it's one of the things they talk about all the time is like all of this money is being spent, but there's actually no quantifiable way of measuring yet whether we're actually getting return on that investment or not. And right now, nobody's thinking about return on investment. They're just thinking about, I've got to get in on this exciting new area that has all this potential and everybody stock is being benefited from being associated with it. But when you ultimately realize that most of these companies aren't making any money, so it's a lot of expenditure, are they even accounting for that expenditure the way that they should based on what the real life expectancy of these data centers are? And if you think about it, it's one of the things about technology is, technology always becomes, more robust and lower cost, right? So the thing is all of the money we're spending now, are we really going to get a return on that? And I think it's, one of the things that's truly going to impact the market. We had a brief period, in the fall where people started questioning that. And
Mhm.
I would suggest that, the market, and especially the Mag 7 and the big hyperscalers that are in that space, their stocks were being, somewhat the valuations were starting to be questioned. I think we've kind of gotten back in that excitement phase again
Mhm.
where people are just still, this time it's different. Old rules don't
Mhm.
apply, and it's why I see so many similarities to that period back in 2000.
Thank you for tuning in to Siebert on Wealth. If you have made it this far, please consider subscribing to our YouTube channel. If you are listening on another podcast platform, please consider leaving us a follow and giving us a review on that platform. We are also available on X, Facebook, Instagram, and LinkedIn. For any other questions, please visit our website. The opinions voiced in this material are for general information only and are not intended to provide specific advice or recommendations for any individual. All performances referenced is historical and is no guarantee of future results. All indexes are unmanaged and cannot be invested into directly. The information provided here is for general information only and should not be considered an individualized recommendation for personalized investment advice. Any investment strategies mentioned here may not be suitable for everyone. Each investor needs to review an investment strategy for his or her own particular situation before making any investment decision. Stock investing includes risk, including fluctuating prices and loss of principal. Any company named noted herein are for educational purposes only and not an indication of trading intent or solicitation of their products or services. LPL Financial does not provide research on individual equities, securities, and advisory services offered through LPL Financial, a registered investment advisor. Member FINRA SIPC.